Everyone dreams of retiring one day, picturing it like a scene from a movie. But when reality hits, it's usually a spreadsheet and a sinking feeling in your stomach. Most people don't realize their retirement savings may not last until it's too late. They work for 40 years, obeying normal advice, only to struggle financially. What if there's a smarter way? A portfolio that pays you monthly without selling your shares or taking risky chances, just by owning the right index funds. By the end of this video, you will learn how to invest, how long it takes, and how this strategy can yield around $2,800 a month. Here's the truth. Most retirement plans are based on a broken assumption that you'll withdraw parts of your portfolio annually to fund life. Markets don't move in straight lines. They crash and stagnate. If you sell during those ugly years, everything falls apart. Imagine saving for 30 years, retiring with $1 million, and then watching a 30% market drop slice $300,000 off your nest egg, just as you start pulling from it. Instead of selling investments, design your portfolio to pay you without touching the principal. Think of it like a rental property, sending you checks. Index funds are the unsung heroes of wealth building. They don't promise to beat the market. They are the market. When you own one, you own hundreds of companies all at once. They pay out a portion of their profits to shareholders. With the right mix of index funds, cash flow can grow every year, covering the gap between Social Security and what you need to live well. Right now, the average Social Security check is around $1,900 a month. This won't cover a comfortable life for most retirees. Instead of hoping for market gains, build a system where dividends are predictable, growing, and not reliant on market conditions. Now, before we talk about the 3-fund strategy, let's cover 2 tools that make this plan almost foolproof. The first is tax-advantaged accounts. These are your 401ks, IRAs, Roth IRAs, the boring acronyms that can quietly supercharge your returns. The reason they're so powerful is simple. They protect your growth from the single biggest drag on wealth, taxes. If you use a 401k, your contributions reduce your taxable income today, and the money grows tax-deferred until you withdraw it later, ideally when you're in a lower tax bracket. With a Roth IRA, it's the opposite. You pay taxes now, but every penny you earn, dividends, capital gains, everything is tax-free for life. Here's why that matters. Let's say you build a portfolio that pays $2,800 a month in dividends, about $33,600 a year. In a taxable account, you might lose 10% to 20% of that to Uncle Sam. But in a Roth IRA, zero. That's an extra $300 a month back in your pocket. Money you could use for travel, healthcare, or anything else that makes retirement retirement. The second tool is dollar cost averaging. It's the simplest investing strategy in the world and one of the most effective. All it means is that you invest the same amount on a regular schedule, every week, every month, no matter what the market is doing. When prices are high, you buy fewer shares. When prices are low, you buy more. Over time, this smooths out your cost and removes the emotional temptation to try and time the market, something even professionals fail at most of the time. It also does something more important. It keeps you consistent. And consistency is the real secret to wealth. $500 invested once is nice. $500 invested every month for 20 years? That's life-changing. So now we have the foundation, a tax-smart setup that lets your money grow undisturbed, and a consistent investment habit that removes emotion from the equation. Next comes the fun part, the actual portfolio. This is where the 3-fund plan shines. It's simple enough for a beginner to manage, but powerful enough to support a retirement lifestyle most people think is out of reach. Each fund plays a specific role, one for growth, one for income, and one for global diversification. Together, they create a machine that's designed to grow, protect, and pay you for decades. But before we break down the specific funds and how they work together, there's something you need to understand. The goal here isn't just income. It's increasing income. Inflation is real. Costs rise. Your retirement income needs to grow with them. And with the right mix of dividend-growing index funds, it will, automatically, without you having to lift a finger. All right, now that we've set the stage, let's get into the part that most people care about, the actual structure of the 3-fund retirement portfolio. And before you roll your eyes and think, this is going to be complicated, let me stop you right there. This isn't one of those over-engineered 15-fund portfolios that require spreadsheets, caffeine, and a finance degree to manage. This is simple by design. 3 index funds, 3 clear roles, and 1 powerful outcome: predictable, growing income for the rest of your life. Think of it like building a house. You don't need 100 different materials. You just need the right ones in the right proportions. And each of these funds plays a role in that structure: growth, income, and stability. Let's start with the growth engine, the part of your portfolio that's designed to supercharge your wealth while you're still building it. This is usually a broad market or tech-heavy index fund that captures the innovation, disruption, and rapid expansion happening in the economy. Think companies like Apple, Microsoft, Amazon, Nvidia, the titans that don't just grow, they reshape entire industries. The reason growth is essential is simple. It gives your portfolio its compounding power. Even if the dividend yield is relatively small, the share price appreciation is what accelerates your net worth and boosts future income potential. In other words, this is the fuel that takes your investments from decent to life-changing. Over a 10, 20, or 30-year time horizon, this portion of your portfolio is what turns thousands into hundreds of thousands, or even millions. But growth alone isn't enough. That's where the income core comes in. This is the steady heart of your portfolio, the part that delivers consistent, reliable cash flow regardless of what the market is doing. It's usually a dividend-focused index fund, one that holds companies with long histories of paying and increasing their dividends every year. These are businesses that have weathered recessions, interest rate spikes, and market meltdowns, and still rewarded shareholders quarter after quarter. What makes this piece powerful isn't just the income today, it's the growth of that income over time. Many of these funds raise their dividend payouts by 6%, 8%, or even 10% annually. That means your income stream isn't static. It climbs higher every year, helping you stay. Now here's where the magic happens. When you combine these three components, growth, income, and diversification, they start reinforcing each other. Growth pushes your total wealth higher. Income provides steady cash flow. Diversification keeps everything stable through market turbulence. And together, they create a portfolio that not only survives in retirement, but thrives. So, how do you actually put this into practice? It depends a lot on your age and how close you are to retirement. Because the younger you are, the more risk you can afford, and the more growth you want. The closer you are to retirement, the more you shift toward income and stability. Let's break down 3 possible approaches. If you're in your 30s, time is your biggest advantage. You've got decades ahead for compounding to do its thing. In this stage, you want to lean heavily into growth, about 50% of your portfolio, because every extra percent of growth now multiplies massively later. Around 30% can go toward dividend-focused income funds to start building that base cash flow, and the remaining 20% into international diversification. This is your wealth acceleration phase. If you're in your 40s, you're in the balance phase. You've built some wealth, but you're also starting to think about protecting it. Here, a 40-40-20 split works beautifully. 40% growth, 40% income, and 20% diversification. You're still growing your money, but you're also laying the groundwork for that future income stream. And if you're in your 50s or beyond, preservation and reliability become the priorities. Your split might look more like 30% growth, 40% income, and 30% diversification. The idea here isn't to maximize returns. It's to make sure that monthly paycheck is consistent, sustainable, and growing long after you stop working. Now, let's talk about the question that's probably been sitting in the back of your mind this whole time. How much do you actually need to invest to pull off $2,800 a month? Here's the math. $2,800 a month is $33,600 a year. If your dividend yield across the portfolio averages around 4%, which is realistic with the right mix, you'd need about $840,000 invested to generate that amount. If your yield is closer to 3%, you're looking at about $1.1 million. But here's the part most people miss. You don't have to save all of that from scratch. Compounding does most of the heavy lifting if you give it enough time. For example, let's say you start investing $800 a month, about $27 a day. In the first few years, progress will feel slow. Your portfolio might only grow to $10,000 or $20,000. But give it 10 years, and it's over $170,000. By year 20, it's around $720,000. And by year 30, it's north of $2.4 million. That's the power of compounding working in the background while you sleep. The best part? During those 30 years, your dividend income is growing too. In the beginning, it's almost nothing, maybe a few bucks a month. But by the time you hit retirement, those dividends alone can cover your living expenses. And you haven't sold a single share. This is the beauty of the 3-fund strategy. It scales with you. When you're young, it focuses on growth. When you're older, it shifts to income. And all along the way, it's quietly building a machine that pays you month after month, year after year. But let's zoom out for a second, because there's something even bigger at play here. This strategy isn't just about money, it's about freedom. It's about designing a future where you're not checking your portfolio every week, wondering if you can afford to retire. It's about knowing that, regardless of what happens in the markets, the bills are paid. The fridge is full. The life you worked so hard for keeps running without you selling a single asset. And that's what separates this approach from traditional retirement planning. It's not a withdrawal strategy. It's not a guessing game. It's a paycheck-generating engine. And once you build it, it keeps paying you, whether you're 55, 75, or 95. Now that you understand how the 3-fund strategy works and how it scales from your 30s to your 50s, let's take it one step further. Because this isn't just about money in a retirement account. It's about designing a life where you're not waking up at 65 wondering if you can afford groceries, healthcare, or a trip to see your grandkids. It's about having control. And control is the ultimate form of wealth. The first mindset shift you need to make is this: retirement isn't an age. It's a number. It's not 65 or 70. It's the moment when your passive income covers your lifestyle. That could happen in your 60s, or it could happen in your 40s. The timeline isn't set by the government or your employer. It's set by how quickly you build that income stream. And the 3-fund strategy is designed to get you there sooner than you think. The sooner you start, the less you actually need to contribute. Time is the most powerful factor in investing. If you start in your 30s and invest consistently, compounding does almost all the work. Even small amounts can lead to a 7-figure portfolio. Waiting until your 50s means you have to save more aggressively. It's less forgiving. The best time to start is yesterday. The second best is today. You can still build meaningful income starting in your 40s or 50s, even if it's not huge at first. Imagine investing $800 a month starting at 30. By year 30, you could cross $2.4 million and receive over $34,000 a year in passive income. Those dividends grow every year. This plan focuses on dividend growth, meaning your income could rise significantly over time. You're not just creating income for retirement. You're building a financial legacy that can help support those you care about. Impatience is a common obstacle. Compounding is slow in the beginning, and that's when many people quit. Building wealth is boring. It's repetitive, buying the same funds and watching your portfolio creep upward. But that boredom is a feature, not a flaw. One day, the boring part ends and the snowball takes over. Your dividends explode, and suddenly your money is working for you. On the other side of that curve, peace of mind happens. You stop worrying about market crashes and checking your portfolio every week. It's not about beating the market or getting rich overnight. It's about building a life where money is a source of stability. The formula is simple: 3 index funds, consistent investing, time. Start today with your investment account and automatic contributions. Every day you wait is a day your future self misses out. Start now. In 20 or 30 years, you'll care that you started. If this video helped you see the path more clearly, please subscribe, like, and comment your retirement goal below. Together, we can build a generation of freedom.